Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will deep dive into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new episodes released every Tuesday and Friday. Thanks for listening.
Hello, welcome to the Prime Property Finance Podcast. My name is Mark, and in today's episode, we're lifting the lid on something that confuses just about everyone: mortgage interest rates. So have you ever come to remortgage and you've heard that the Bank of England base rate has gone down? However, when you look at fixed rates, they've actually gone up. Well, we're going to take a bit of a look at that to help you understand exactly what's going on and perhaps help you get a better deal as a result of what's going on in the market. So what are we looking at in particular here? We're looking at both something called Bank of England base rate, which is the one that you will hear on the news. The MPC will come together, who are the Monetary Policy Committee, will come together and they'll decide whether base rate should remain the same. Now, this is a rate that will influence basically short-term borrowing and savings rates. This is effectively the cost of money to banks as a whole if they were to borrow money off the Bank of England. Okay, when the base rate changes, this impacts variable or tracker rate mortgages directly. So if you've got a margin over Bank of England base rate, then that is of particular note to you as a borrower. And then we've got something called the swap rate. Now, the swap rate is used to price fixed rate mortgages. So what is the swap rate? Well, this is a rate that sort of guesses, if you like, or looks to the future of what the Bank of England base rate is going to do. The swap rate is the rate that lenders will borrow money between one another, and they'll try and predict what the base rate is going to do over the next 2, 5, or maybe even 10 years. And they will price that in. So if you've had a short-term increase, for example, in the Bank of England base rate, however, the predictions are that that is just a short-term spike and it's going to drop back down, you may see that actually the swap rate may not change at all. In fact, it might actually come down if the longer-term predictions are over that. We're also in a particularly unique position at the moment where we see the short-term fixes are higher than the longer-term fixed rates. Now, that is a symptom of the market. There's a lot of volatility out there at the moment through macroeconomic or global events, which are influencing things that are going on around the world, which will ultimately impact the cost of money, as money is an international commodity, if you like. So looking at the market over the short term, we can see the volatility in that. So if inflation goes up, the Bank of England base rate may go up. And as such, the 2 or 3 year fixed rates may have to price those changes in because they haven't got enough time to ride out the decreases that come with it. Whereas the 5 or 10 years will, as you say, have a longer term forecast and typically will steady out the peaks and troughs that exist in the marketplace. So just to create a distinction between both, we've got the base rate, which is today's rate, and then the swap rate, which is effectively the market's forecast as to what is actually going to happen with that. So that's why fixed rate mortgages can go up even if the base rate doesn't. Okay, so what's also important to know about this is how different lenders fund mortgages. Now, certain types of lenders will actually be influenced more directly by these rate changes or swap markets than others. So let's look at high street banks, for example. A high street bank typically will fund their mortgages, not exclusively, but they will typically fund their mortgages from customer deposits. So that's savings. Okay, so how a bank fundamentally works is that they will offer you an interest rate at, say, 3% on your savings, and they will lend that money then out at 4% with the 1% being their margin. Okay, that's an oversimplified version of a bank, but that's essentially what is going on. Okay, so where we see the swap rates going up and down, that doesn't really impact a bank who may have larger deposits, can dictate what they want to pay in terms of interest to attract those deposits, and then subsequently lend them out. So they dictate their own borrowing costs in many respects. So you won't see necessarily high street banks' interest rates changing as frequently when the Bank of England base rate will change, or if the swap market gets influenced. Now, the swap market does directly influence what we call specialist lenders. So these are lenders that are not banks. They are funded through the wholesale markets or institutional funding of some description. So they will have a credit line. In effect, think of them as intermediaries. So they are borrowing money at one price and they're lending it on to you at another price and then keeping the margin. Now, the price of that money will obviously be passed on to you as the borrower as and when those markets change. So they will lock in a certain pot of cash, X million, that they anticipate to lend over the next couple of weeks, for argument's sake, and they will lock that in at a price. They will offer that out to the borrower, and then once that money's been exhausted, or if rates should change, then they will subsequently change their rate in accordance with how much the money's costing them to buy. So understanding the type of lender that you're dealing with will also help you understand the impact of rate changes and how, where we see in the specialist lending space, it's quite volatile at the moment, and we're seeing rate changes a couple of times a week with some lenders. It's really being that volatile. So understanding that will really, really help you to know whether you need to act quickly or whether you have a bit of time on your side in regards to that as well. So something else to consider around how lenders are funded, which will determine or help, which will actually impact the cost of monies, is something called securitization. Now, I won't go into this in huge detail. It's something I'll share. It's a bit of a rabbit hole if you want to get down that. But securitization is basically where they've effectively sold a load of mortgages. So they've got all these mortgages, they bundle them up, and then they sell them on. And what that does is create a liquidity. So if you say lent 100 million, for example, at one price, they will sell those on and get the 100 million back for it, and therefore they can relend that money again, and so on and so forth. So that's another way that lenders will actually create their money on that front. Okay, so just to surmise off of the back of this then, what are the 5 key takeaways we can take from interest rates and mortgages and how they behave? So mortgage pricing is ultimately a mix of base rate, swap market, and how lenders raise money. Okay, so all those forces are at play. Not all lenders are impacted in the same way. It really does depend on how they're funded and what their funding model is. Fixed rate pricing is often more about forecasting than it is today's reality. So again, as you say, the longer you fix in theory, the better the product should be. And don't be surprised if fixed rates move even when the news says that base rate hasn't. As you say, this is around the swap and the forecast and predictions based on what we believe is going to happen in the future. And that will ultimately impact it. So hopefully you found that useful. So just to surmise the main point, mortgage rates are driven by the cost of money, and that depends on where the lenders get it from and what the market thinks is coming next. So I hope you found that useful. That's a quick whistle-stop tour of interest rates and why you might see them differing versus Bank of England base rates, swap rates, fixed rates, and so on. So if you've got any questions, then just drop us a note. Our contact details are in the show notes. Hopefully you found that useful, and see you in the next one. Take care.
Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you could give us a review and subscribe to the show. If you'd like us to answer any questions or go deeper on a specific topic, then please drop us a message. And also, please follow us on social media. All our different handles are in the show notes below. Thanks.